We surveyed chief financial officers for our first quarter CFO survey in late March and early April of 2019. That was against a backdrop of the House of Commons rejecting the Prime Minister's Brexit deal for the third time and failing to agree on an alternative, and the start of talks between the Labour Party and Conservative parties on a way forward on Brexit. So clearly a time of great uncertainty. And yet, when we look at risk appetite on our survey and business optimism, they are at pretty much the same levels that we recorded in late December. Very low levels, but pretty much unchanged. And I think the message is that by the end of last year, CFOs had locked in to a more hostile and uncertain environment, and recent developments haven't materially changed that view. Now, three other themes emerged from this survey, and three sort of significant risks facing the corporate sector. One is from slowing revenues. CFOs expect revenue growth to continue to decelerate. They see rising cost pressures driven by wage growth. Indeed, a record 79% of CFOs say they expect costs to rise over the next 12 months. And we're also picking up a slight deterioration in credit availability and an increase in credit costs. So credit conditions slightly less favourable than they were 1 year and 2 years ago. Now, how are chief financial officers responding to this environment? Well, there's a clear, very strong focus on reducing costs and above all on building up levels of cash. At the end of last year, official data show that cash levels on UK corporate balance sheets hit an all-time high, up by over a third in the last 2.5 years. CFOs tell us that they plan to continue to accumulate cash, and at the fastest rate in some 9 years. So I think the message from this survey is that the corporate sector is in defensive mode, and it is very much battening down hatches for uncertain times.